Hello and welcome back to Core Finance. I'm Matt Brown. I'm joined today by Marc Ostwald, who's a strategist at ADM. Good morning to you, Marc.
Good morning.
Thank you very much for coming onto the show, of course. And yesterday, Bank of England.
Yeah.
What's your take on what's going on there?
Well, they made some. I think the key point is they noted that the shift that we've seen in the coming economic data. Above all, I think they probably surprised us, having had the average earnings numbers on Wednesday, which was slightly below expectations at 2.1%. They then went on to describe it as being above the level that they had been expecting at the time of the August inflation report. And obviously they made this comment that basically it may well be appropriate to raise rates in coming months. Now, obviously we've been here quite often before. One can recall that way back in 2013, when we had the start of forward guidance, one of the first bits of forward guidance was that if the unemployment rate fell below 7%, then a rate hike would be likely. Obviously, this week, when we had the unemployment level, it was 4.3. And that was there has been a good deal of skepticism in markets in reaction to it. However, this morning, we've had a speech from Mr. Vlieger, who is identified as the most dovish member of the MPC, and he has reiterated this message that a rate hike may be appropriate in coming months. So we're now pushing sterling a lot higher. We were, when I left the office, it's probably moved a bit higher in the meantime, discounting about a 55% chance of a rate hike in November. That's probably going to rise quite a lot more, particularly if incoming economic data is reasonable. It doesn't have to be particularly strong. Likelihood is inflation will continue to rise. The bank's already told us that they expect it to be above the top end of their target by October, and there will obviously be letter writing. And that, in a sense, is what forced their hand. The situation in comparison to, say, 2009, 2011, where we also had well above inflation, above target inflation, is of course different insofar as the economy isn't in recession. It may be growing slightly more slowly than it did last year, but it's not in a situation where they would be almost forced to look through that rise. So that puts us there with the Bank of England. I think they'll be watching carefully what other central banks do. But for the time being, the markets probably will accord a fairly high probability now, given that even the most dovish member appears to be on board with a rate hike.
Understood. And speaking of other, we've got the MPC, we've got the Fed meeting next week, and we've got CPI data out today. How do you think that will impact the Fed and their decision next week?
Well, we had the CPI data in the US yesterday, and we've got the retail sales and the industrial production numbers today. The CPI number was higher than expected, primarily driven by gasoline prices, one has to say. But nevertheless, core CPI came in also slightly higher than most people were expecting. It's still off where the Fed would probably want it, 1.9% on CPI, core CPI at 1.7%, still a little bit substandard, but you basically now have to start thinking that the market's doubts about a December rate hike are probably there's been too much emphasis on those doubts. So in terms of the retail sales and industrial production numbers today, retail sales likely to be fairly robust. Headline not quite so strong. We're forecasting 0.1 with a bit of a drag from auto sales, which we know about already. But core retail sales, if it comes in at 0.3%, as is expected, that would imply over the last 3 months we've had a 4.2% 3-month annualized rate of retail sales, pointing to strong personal consumption. The Fed, for the time being, obviously next week, is going to be concentrated on its balance sheet reduction program, or starting it. We know most of the details already. In terms of, all we're really waiting is for them to pull the trigger. The details are, in essence, that they will start by reducing their balance sheet by $10 billion a month. Not a huge amount when one considers that the ECB and the BOJ are still injecting a lot of money via their QE programs. That will gradually, per quarter, rise by 10 billion per quarter till we get to 50 billion by Q4 of next year. And that will probably start to have a more significant impact on financial markets. I think the more important thing, though, in the short term is we've had a lot of dollar bearishness because we're primarily concerned that the Trump administration isn't really giving the bump that was hoped. But there are some better noises on that front. Obviously, geopolitical risk still casts well, geopolitical and domestic political risk still casts a fairly long shadow. But we are in this situation where probably the dollar bearishness has been overdone. That markets may well find that by the time we get to the end of November, the Fed is already starting to guide them to another rate hike. And we're probably likely to see a slightly higher rise in yields. And I think sort of the last thing in terms of what's happening today is we've obviously got equity and index and options expiry, the quarterly expiry. Now, the notable thing about September expiry is it's normally a one which is, once we've done the expiry, it normally signals a change in direction from where we were. So we've been going up, and quite often over the last, actually out of the last 10 years, bar 1 year, I think that was 2013, it's basically always had a sharp reversal of whatever had been going on beforehand. So we may, in an environment where the dollar starts to recover somewhat, find that the equity markets, and indeed with central banks starting to be less accommodative, find that the market, the markets for risk assets are perhaps not so well underpinned as they have been.
And we see the Dow Jones reaching record highs. This could be the top of the market. That could have been the last chance.
Well, I'm not sure it's necessarily the top of the market, but I think it's certainly a situation where we are overdue a correction without a shadow of a doubt. And if, you know, the possibility that you've got a less accommodative ECB, a Bank of England rate hike, the Fed starting to reduce the size of its balance sheet and then probably going with a rate hike, you are in a situation where the charge into risk assets needs to be questioned, and particularly when one starts to look at the amount of carry trades which have been put on into emerging market currencies. If you saw the dollar recover, then you probably see some of those quite a sharp exit out of particularly domestic equity and bond markets in emerging markets, particularly the ones where real rates are not particularly high.
Understood. Well, on that note, Marc Ostwald, thank you very much for joining us today.